Hi folks, in this video, I'm going to answer a very common question I get via YouTube comments, via email, with new clients, which is, should I run my business as a sole proprietorship? That means no legal entity, or should I set up a corporation, an LLC, an S corporation in order to run my business? Now, I find it that most people, when they ask that question, the question behind the question is which legal entity is best for me for tax purposes. In other words, which one's going to have the less tax burden, because it does make a difference. Your legal structure does change your tax liability. Now, I will answer that with detail, and I'm going to do a couple of examples, but I also want you to consider that there are other factors that come into play when choosing a legal entity. The number one factor to me is the flexibility or administrative burden. So if you're going to have a really, really small business, is it worth it for you to have annual meetings with the shareholders, even if you're the only shareholder? Keep records of that. Maintain the corp or the LLC in your state by paying the annual fees. Is it worth the extra administrative burden of separating the business monies with the personal monies, etc.? Even though as an accountant, I generally would recommend that regardless of the administrative burden, the reality is that not all businesses are the same, and not all business owners have a very large business. Maybe a lot of people have sort of a small side hustle type of business, and sometimes it's worth waiting until it's worth going through all that. So anyway, so that's one factor, the flexibility or administrative burden. The other factor to consider is liability. So will I be, as the owner, personally liable for mistakes my business makes? So generally speaking, when you have a sole proprietorship and you don't have an LLC or a corporation, the answer is yes, you are personally liable for any mistakes the business makes, and your customers can sue you and go after your personal assets. Whereas with a corporation or an LLC, generally the personal assets of the business owner are protected, and it's only the assets in the corporation that could be eligible for liability or to be used as repayment in a lawsuit sort of scenario. In either case, a liability question is a question for an attorney and not for an accountant, but I know enough about it where I can discuss it in those general terms. Now, the other factor to consider is ownership structure. If you're going to be the only owner forever of that business, you might want to stay with a sole proprietorship or go with an S corporation, something that's really tax efficient. Again, we'll discuss that in a second. But if you plan to bring external investors, limited partners, if you plan to go public, then you have to look at either an LLC or a corporation. Generally, if you are going to go public and have a lot of external partners, a corporation is the best because you don't report income and losses to the owners. You only report dividends, actual cash outflows to them. So investors prefer to invest in a C corporation so they don't get what's called a K1. I don't want to get too much into the details with that, but if you were to do an LLC partnership, they would get a K1, which means in any good year, they would pay tax on the profits of the business, even if money was not distributed. So again, if you are going to have external investors, C Corp is probably going to be the best choice, period. Although LLCs are also a good choice for that. Now, if you are going to have less than 100 owners and it's going to be a closely held business, I think an S corporation is almost always the best case. Again, we have to discuss case by case, but that's typically where we go in the recommendation when it comes to that situation. Then the next question is the annual fees. How much does it cost to pay annual, the whatever maintenance cost, the annual renewal, the annual report that the states charge? Now, you could do general Google search. I went to llcuniversity.com. It's pretty good. I usually recommend it. If you actually go through all the states, you will see that there are some states that is really expensive to maintain. For example, in California, it costs you at least $800 per year to renew your LLC. This is whether or not your LLC makes any money. If you go down to Florida, it's about $138.75. That's where most of my clients are. If you go down to, for example, Maryland, that's $300. Massachusetts, $500. So this annual maintenance fee concept does vary by state. Anyway, let's move on to tax, which is the main reason why you're probably here. And the question of whether a C corporation, an LLC, or an S corporation is better for tax purposes, it's also heavily varied by state. Now, I'm going to do a numerical example using Florida, which is the state that I live in and the state that most of my clients are in. So I'm going to show you what that looks like, but that example will vary by state. For example, if you look at this map from taxfoundation.org, you can see the tax cost of corporate income tax by state. For example, California is paying an average of 8.84% on corporate income taxes, Iowa 12%, Pennsylvania almost 10%. So that gives you a general idea. There are some states that are pretty expensive. For example, Wyoming and South Dakota, neither one have a corporate income tax. So that's actually a state where a lot of people want to set up their corporations because they will not pay corporate income taxes. So then you have to deal with the maintenance fees and deal with having an address over there if your business is not based on that state. So it's not as simple as just choosing a state, but that's just to give you a general idea. If you look at states like Washington, Nevada, Ohio, Texas, these are states that don't have a corporate income tax, but that have something called a receipts tax, a gross receipts tax, which is very similar, but it's not based on your profit. It's based on your total sales, and it does vary by state, but usually these are for companies that have over $1 million in sales. Again, this varies state by state. Don't quote me on that number, but for really small micro businesses, they're usually exempt from that gross receipts tax. So this map gives you a general idea, and you see the variance all across the board. You go from Wyoming 0 to Iowa 12. I mean, that's a pretty big range when it comes to, deciding, which state you want to incorporate in. Generally, you want to incorporate in the same state where your headquarters are, where you operate from, just because administratively it's much easier. But some companies do get kind of fancy and they actually set up headquarters in a different state for interstate income tax planning purposes. Now, I'm going to open up this spreadsheet that I have. And in this spreadsheet, I did an example. I really literally ran a simulation in my tax return. If there was a company that had $100,000 in net profit, $100,000 in net taxable income, and whether the business was a sole proprietorship or a single member LLC, a multi-member LLC, an LLC with multiple owners, a C corporation or an S-Corp, I did the calculation so you can see the illustration. Again, this is with $100,000 and this is with a single person with no kids based on the 2020 tax year. That's another really important concept here, that in order to answer the question, which entity is better for tax, I would have to have all those facts. I would need to know, what your other sources of income is, do you have kids, all that stuff, and what state you're in. So it's not a simple answer. But this gives you a general idea. A lot of businesses make $100,000 around there. So it gives you a good idea. So let's start with a sole prop or a single member LLC. So if you do nothing, you don't incorporate, and you run your business as a sole prop, that means you file in your Schedule C. Or if you set up an LLC and don't make any special elections and you're the only owner, you would fall into this first category, which is sole prop or single member LLC, which are the same for tax purposes, at least in Florida. This is a Florida example. So somebody making $100,000 net in a sole prop or a single member LLC will pay a net tax of $26,000 and change, almost $27,000, which gives you a tax effective rate of about 27%. So that gives you an idea, more or less, for sole prop single member LLC. If you have a multi-member LLC or a partnership where you have multiple partners and you are a general partner, not a passive partner, we'll discuss that in a second, but you're a general partner, most entrepreneurs would be general partners, and you take home the percentage of the profits to be the equivalent of $100,000, then you will pay the exact same tax as the first example. So we're close to that 27% effective tax rate. Now let's look at a C corporation. Now a C corporation actually pays tax as a corporation. In Florida, in many states, with the exception of Wyoming and South Dakota, it does pay a tax. For example, in this particular calculation, if the company made $100,000 net, it would pay $2,700 in Florida state income taxes. So that gives you a net of $97,000 left, again, assuming that all other expenses have been accounted for and all that stuff. And if you were to take home the entire $97,000 as a C-Corp, you will be paying a little bit over $29,000 in tax, which gives you an effective tax rate of close to 30%. So in this particular example, in this vacuum, where we're comparing a sole prop or single member LLC versus a C corporation, the sole prop or single member LLC, it's a better choice because that's 27, close to 27 versus 30%. Now let's take a look at the scenario where it's a S corporation, same 100,000, but the way S corporations work is you have to have payroll. You have to actually run a payroll at least once per year, and that payroll needs to be reasonable compensation, which the IRS needs to deem that the owner employee paid himself or herself a reasonable amount that they would pay otherwise someone doing the exact same job. So in this particular example, let's make the assumption that this company that has $100,000 in profit pays in owner salary $50,000. So there's going to be a payroll tax of $7,650 because there are payroll taxes, Medicare and Social Security. And the net distributable amount in this case would be $42,000. So you got the payroll for $50,000 minus that tax, obviously, and then the extra $42,000 you have left that you can distribute yourself. In an S-Corp, doesn't matter if you distribute the whole thing or if you leave it on the company, you will still pay tax in that net amount, in that net profit amount. So by taking $50,000 home plus $42,000 in distributions, whether you take it or not, your total tax, combining all the taxes across the board, would be approximately $20,900, which would be about 21%. So in this scenario, comparing a single person with no dependents, this being the only source of income, that income being $100,000 from the business, the best scenario is an S corporation. Now, this is not always going to be like that. However, in most cases, for small businesses, the S Corp almost always ends up winning. This is why you've heard from so many people that setting up an S corporation is the most tax efficient option for your business. Now, in this spreadsheet, I go a little bit longer, a little bit deeper, because usually when clients hire me to make this sort of analysis, we look at multiple scenarios. So I'm going to unhide all the other columns that I have here, just so I can show you, whoops, that was a hide. Let me unhide so I can show you a couple of other potential scenarios. For example, let's say we have a multi-member LLC and there's a limited partner and a general partner. So one is actively running the business and the other one is just an investor. So a limited partner is going to pay less tax because a limited partner doesn't pay self-employment tax on income deriving from limited partner or multi-member LLC where they don't have active participation. So the same $100,000 to a limited partner, it's $15,000 in tax. So it's only 15%. So when you have a partnership or a multi-member LLC, the tax varies whether you are the active partner or a limited partner, that all that person is doing is investing in the business and waiting for return in their investment. So that it's a variable that's important to consider. Now, let's say we have a C corporation and instead of distributing the $97,000 that were left in the business after paying the state tax, let's say that you distribute nothing. So you run the C corporation, you get paid nothing, you keep all the profits inside the corporation. So that would be this example here where you have no distributions. So in this particular example, when your C corporation makes $100,000, you pay your state taxes, you have $97,000 left in cash, you don't distribute anything, you don't pay yourself anything, you don't use business funds to buy something personal, then you only be paying around 23.8%. This particular case is really important because C corporations, the tax that we calculate at the end to the owner, what matters the most is whether or not the owner actually distributed himself or herself any dividends, or whether it's all of them or some of them, that matters and it changes the effect in tax. Now, the reality is that eventually you have to distribute yourself that money. So whether you save it 1 year doesn't mean that you save it forever. Eventually, when you pay yourself that amount, you will have to pay it. However, in this example, I do show it because it's important to know what year 1 of tax looks like and simulate year 2 and that sort of thing. Again, that's what a lot of accountants do when a client wants them to do a full simulation of what their particular case would be like based on their income, their circumstance, their state, and go through that simulation if you want to really know which is the most at least tax effective entity to consider. And in this spreadsheet, I don't have the annual cost built in here. And this is only for Florida, right? So you have to consider this specific state, the tax rate of the state, and the annual fees associated with maintaining the LLC or the corporation in that state. Let's look at another example. I'm going to show you this one. Let's say we have a C corporation that makes $200,000. Okay, you're going to see that the state tax is a little bit higher. It's about $8,000 in state Florida state income tax. Then the net available to distribute is $191,750. Let's say you distribute yourself all the profits, you take them home. Then your effective tax here, overall tax, if you add all the taxes, you're going to pay about $80,000 in tax, which makes it closer to almost 41% tax. And the reason why this becomes so high is because a corporation has the concept of double taxation, where you're paying tax at the corporate level and at the personal level. Double taxation doesn't happen in the S corporation, which is where the deep savings are. We're going to move into and look at all the different options in the S corporation. Let's look at two scenarios with a C corporation that makes $400,000 net. So I got scenario 1, we got $400,000 net, and the owner pays himself or herself a payroll of $100,000. And on top of that, whatever the net is of the profits after paying the payroll taxes and paying the state taxes, he or she distributes himself $265,000, the entire net on top of the payroll that they pay themselves. Notice that their effective tax rate is closer to 43%, 42.5%. Again, adding state and corporate and personal. So we're adding all the taxes together. And remember, in Florida, there's no state income tax for individuals. So the only state tax being factored here is the corporate income tax. Again, in your state, it's going to be a different simulation. If you look at the same $400,000, but the owner, instead of distributing himself or herself the entire $265,000, only distributed himself or herself $100,000. So you got the $100,000 through payroll, through a paycheck, and then the $100,000 through a dividend. So then the tax that individual would pay on that year, where they only got $200 out of the $400, they would be paying about 30.9% tax. So you see how that varies based on how much money they take out that year. Now let's look at the S corporation. We saw the first example where there's $100,000 in net profits, $50,000 went through payroll, then the net tax would be about 21%. We're going to look at another scenario, which is a single person with an S corporation making $200,000, and whether or not they distribute themselves the whole thing or none of it, it doesn't matter in the S corp world for tax purposes. What matters is that they have some payroll, reasonable compensation. So for example, for a $200,000 net profit S corporation, we decided to pay the owner $100,000 in payroll. The calculation in this one is almost 26% in tax. Again, all the taxes combined. And then we have an example with a $400,000 net income small S corporation, where there's the same $100,000 in payroll, and then the net $284 gets distributed. The tax would be 31.7. So again, take this as simply just an illustration. Your state matters, your circumstances matter, how much money you make other than the corporation or LLC that you're setting up matters. All that stuff matters. But generally, and I hate to make blanket statements like this, generally, for most of you, I'm going to say 95% of you, I'm willing to bet that if you're okay with the annual maintenance fees and whatever it costs you to run payroll, because you do have to pay a payroll company or learn how to do payroll and withhold tax and get through all the administrative burden. Once you get all the administrative burden out of the way, the S-Corp is typically a better choice than being a sole proprietor or a C-Corp. Again, not always the case, but typically it will be. So that's something to consider. Again, you want to contact your accountant, ask your accountant. My clients can ask me, right? I'm their accountant, but you got to ask your accountant to do a simulation for you if you want the right answer. Now, this is a lot of work to do this. It's not like you can plug numbers on a spreadsheet. There's a lot of variables here, and you will literally have to have one spreadsheet per state, per single married head of household, based on the number of dependents. You would have to have so many moving parts on this spreadsheet where it's just easier to just plug and play the information in tax software, which is how I do it. I just put it on the spreadsheet for comparison purposes so you can see it. But generally, when somebody asks me to do this, I take all the facts and circumstances and I prepare a whole tax return without filing it to come up with the number, because there's just so many moving parts in a tax return, and every year varies. Like in 2021, the tax credit is higher than 2020, for example, and there's stimulus checks. So there's so many moving parts that it's difficult to have just one blanket statement. But again, generally, I think that the S-Corp is the most tax efficient. Now, on the question on the legal aspect of it, so for example, liability, flexibility, all that stuff, I recommend jumping onto this page by LegalZoom. I'll put links to everything I showed you here in the description. You can check them out. They do a really, really good job at summarizing these things without talking about the tax aspect of it. Like you will see something like tax once or twice, right? Something like that. Tax once. I mean, that's some information, but without the spreadsheet and without the illustration, it's really difficult to know exactly what that means in the real world. But they do an excellent job just summarizing these here. And LegalZoom is a sort of a national law firm, virtual law firm. They can do the incorporation process for you. You just click on any of those buttons. They're not paying me. They haven't sponsored this video. I'm just kind of clarifying what getting started means. And LegalZoom, if you want to sponsor one of my videos, you're welcome to do so. But this is just one really good one. Again, you can Google LLC versus Corp, and you will find hundreds, if not thousands or millions of different websites explaining to you the differences, and some of them offering the service of creating these corporations for you. Now, I personally my company sets up corporations in Florida. We set up corporations, LLC, do S-Corp elections. That's an IRS thing. It's not a state thing. But we only do Florida because that's what we know. And when somebody wants to do it in a different state, Wyoming, Delaware, California, whatever, we refer them to websites like this or a local attorney in that state to go through the process of setting up that corporation. I'm an accountant. I know numbers. I know tax. That's my thing. On this stuff, on the legal aspect, I can't give full advice, but I can be general enough or point you in the right direction where you can make the conscious decision on your own. Or if you want true legal advice, that's where you seek an attorney to get specific to the type of business that you should have based on what you do, your profession, the type of licenses that you have, all that legal compliance stuff. That's not my thing. My thing is numbers. So anyway, I hope you enjoyed this video. All the links will be in the description below, and I'll see you on the next one.